All right, AJT fam. Well, welcome back to our day trading class. This is the fifth class, and we've got pretty much got all of the foundation down. If you missed the first four, go back and watch it. Take your time, go through it, because that kind of sets the foundation for where we're going to be going from here. And it's very, very important that you get that, because a lot of people don't succeed in trading because they neglect to go get the foundation. They think that they're better than that. They think that, they're grown, they're smart. We don't need to go back and learn our ABCs. But I guarantee you, if you don't do that, you probably won't make a penny trading. You'll probably give money back consistently. So you've got to get your ABCs down. So don't skimp on that. All right, so again, we've gone through the foundation. The simulated trading part, that should have come when you were going through the roadmap to success, when you're doing the exercise. We're going to talk more about, I'm going to bring that in at different points, especially during the strategies. So we'll talk about the simulated trading, some things you can do if you're not in the market and you want to practice and all that stuff. So we'll talk about that probably next week, after we wrap up the opening range trades. But today we're going to start on the opening range strategy. So we're over here. We're on the strategies now, and we're going to pick some of this up. Actually, you'll be learning a little bit of the technical analysis as we go through the strategies, because especially with the opening range trades where we scan and we have to, vet the stock to make sure that it's going to be a good trader. That's all part of technical analysis. So you've got the foundation. You should understand a lot of the basics, so you won't be lost when we're going through it. So today we're going to start with the opening range trades. So you guys know I like simple things. I'm a keep it simple, stupid person. And I like simple trading methods that make sense. Now, I'm sure if you've been around trading for a long time, you have run into people that have all the same strategies, but they all have different names for them. Okay, all the same strategies, but they name them differently. But if you peel everything out away, and at its core, it's the same strategy. And so we're all practically going to learn the same strategies, but how it looks to us after we finish growing and we've developed into our own trader, it may look different. Because what we're going to do is we're going to make it our own. We're going to make it make sense to us and work with how we see the market and how we feel and all of that. So that's why I'll never tell anybody that they're wrong. You're wrong for doing that. So hey, if that's what you see, if that's what you feel, you've got to go for it. And if you do it multiple times and it just doesn't work, if you've done your reflection like you're supposed to, you will come to the conclusion that maybe what I'm doing is not working. And you should have been able to figure out the reasons why. So, the reason why I focus on simple strategies is because, contrary to popular belief, complex strategies do not equate to more profitability or better consistency. If it's complex and it has more moving parts, that means it's less consistent. My mindset when I was studying to be an engineer and when I started doing things was, the less moving parts I can put in something, the more reliable it's going to be, the more consistent it's going to be. I brought that into my racing. My race car was It didn't have all of the bells and whistles. It had the basics. It had just what I needed to get the job done. And I had less issues, less problems, less headaches. And my car repeated. It was more consistent. And that's what I brought into trading. And that's what I'm trying to teach you guys as part of this trading. And see, I've been down the road that you're going. I've been through it. And you guys that have been with me since the beginning, and you followed my blog from when I started back in 2014, you see I've been through it. I've gone through this whole ordeal. I've dealt with just about every problem that you guys are going to deal with or have dealt with. All right, so I know focusing on simple strategies with less moving parts, it's going to make you more profitable and more consistent. Now, and again, the more complex the strategy, the more difficult it is for you to understand, execute, and manage, because there's way too many moving parts. And I'm sitting here, if I stop for a minute, I'm sitting here watching Tesla. I need a bigger bounce up over 237 to get in. All right, so opening range trades. This is how I start my morning. You guys know this is the first, this is the very first strategy I look at in the morning. Now, there are trend continuation trades that I look at pre-market, that we'll get into those after we cover, the basics. And when we're talking about trend continuation, well, actually, trend continuation is the next strategy. So when we cover that, I'll kind of bring in how I implement that in pre-market. Because we've seen that the pre-market price action tends to be a lot better than the price action when the market opens. So the opening range strategy, this is a simple entry strategy. It's been around for more than 50 years. And it remains one of the most popular entry strategies today. A lot of people may not admit to it because they may think, oh, this is just an elementary strategy or whatever. I don't care what you do. Ross's gap and go is a damn opening range breakout. It could be on a 24-second chart. It could be on a 1-minute chart. It doesn't matter. It doesn't matter what you call it. It's the same strategy. You can either speed it up or slow it down based on, how you feel. So I know several professional traders and fund managers who use that opening range. And it ranges from 2 minutes to 60 minutes. They trade all the FANG stocks, including Amazon and Google. And they trade on a 60-minute time frame. They trade the high beta names. A lot of stocks that I can't even trade. But they use a 60-minute chart, and they make tons of money on it. So basically, the opening range is the highest price and the lowest price traded during whatever the time frame that you're measuring. If you're using a 24-second chart, I don't know why the hell you would be using that, but if you use that, then the opening range is the first 24-second candle. If it's a 1-minute chart, it's the opening 1-minute candle. Sets the high and the low, and that's your opening range. For me, right now, it's the 5-minute. Now, when I started, way back when, if you go back and go through my blog, you'll see I was trading a 15-minute opening range. That's what I was trading. The 15-minute opening range. So it doesn't really matter what time frame you use. Whatever time frame it is, that's going to set your opening range. And the opening range is important because it practically sets the tone for the remainder of the day. What it does at the open. Now, sometimes the 5-minute candle just doesn't do it. Sometimes it takes 20 minutes. Sometimes it takes 30 minutes for a stock to settle. But the opening range is pretty much what sets the tone for the day. Between the closing of the previous trading session throughout aftermarket and the opening of the current session, a lot of stuff can happen. We know the market, like the SPY trades 24 hours a day, 5 days a week. And you could wake up at 2 o'clock in the morning and look and see where the SPY is trading. Where's the S&P, futures trading? You'll be able to see that. And even though you could see this, the market gap down or gap up, you can see that those events, whatever happens, can have a major impact on the upcoming trading session. You have government reports. You have things that happen overseas. You have earnings. A lot of things that can go on that can move a stock. But just because it got up or got down doesn't necessarily mean that it's going to go that direction. So we have to wait and let it settle in and let it give us some direction. Typically during the first half hour of the trading day, that's the most emotional part. You've got people that can't trade until the market opens. And let's say they got up and they're wanting to take profit, or they were short, they're having to kill their trades. You got people, inexperienced traders, that are like, man, this thing is gapped up and it's going to run. Everybody's excited. And you see that in the price action. If you sit back and just watch the candlesticks on the most popular stocks, or the stocks that have the most volume coming into the open, there's no way you can really get a grip on what's happening. And we'll look at Roku's chart here in a minute, and you'll kind of see what I'm talking about. But what the traders are doing is everything that happened overnight or that happened after the close, and until the time that they're able to log in and actually trade, all of that emotion is built up, and that's what's coming in. So institutional traders, they're coming to the market, buying and selling, massive quantities. The computers fire up. The volume is just outrageous. And it can have a really strong impact on how the market is going to move that day. So it's difficult to see what the impact of what happened overnight or what's being reported pre-market. It's hard to really gauge the actual impact that it's going to have until the market opens and it actually starts trading. We can guess. There are people that guess. Sometimes they're good at guessing. But all it takes is that one bad guess to tear them a new one. To just rip up everything that they have earned over that period and send them packing. So it's very important that we wait. That's why I like to wait. Now, if I trade the pre-market volatility, not the volatility, if I trade the pre-market strategy, if I trade the trend continuation, then I'm probably going to be out of it before the market even opens, because I'm going to wait and let the volatility go. Now, if I've taken profit, yeah, I'll probably leave it on with a stop, so that if it does get some volatility where it's going and I'm making a whole hell of a lot more profit, I'll be in position. But if it doesn't, it'll stop me out and it won't hurt me. But the main thing is the 5-minute opening range strategy is designed, or not just the 5-minute, the 5-minute, 10, 15, it's designed to allow that opening volatility to settle and give us a good direction to trade. So, why don't I extend trading breakouts all day? Well, the reality is the volatility is gone. After 10 o'clock, 10:30 at the latest, the volatility is gone. And so it's easy for these high frequency traders or these big funds or big investment bank people to actually create fake breakouts. They know new traders, or they're taught from the beginning to buy breakouts. Now, I don't teach you guys to buy breakouts, initial breakouts, but there are a lot of people that do. And the problem is, if you wait too late in the day, 9 times out of 10, they're going to be false breakouts or false breakdowns. That's why you'll see when we get into the trend continuation that I like to wait for confirmation, because they can move a candle above or below a level, sucker some people in, and then rip it back the other way. If it never confirms, it's not going to be a good thing. So trading just range breakouts is really a bad idea, because it's easy for them to create fake breakouts, suck in a lot of people, suck up a lot of money, and then let the stock go wherever it's going to go. How many of you guys have bought a breakout only to get stopped out and it turns around and it ends up going in the right direction? Or you might have done it once or twice. You got in, you got stopped out, then it starts to bounce and you anticipate the break, and it breaks out for a minute, then pulls back and you end up getting stopped out again. That is the new trader trick. That's why I don't teach you guys that. That's why I don't cover trading these breakouts. I know, and people say only suckers wait for confirmation. Well, that might have been true back in the day, but now with the how technology is taking over, you better wait for confirmation, or else you'll be the sucker. So what we like to do, and you hit the nail right on the head, John, slowing down the time frames, slowing it down. That's why I don't trade a 1 minute or a 2 minute. And I tried looking at the 3 minute opening range this summer when things were slow and volatility was down, but it turned out to be just like the 5 minute. Now, I might have made a couple of bucks on the 3 minute, getting to a earlier target, but it never really amounted to much. And even now, sometimes 5 minutes may be a little bit too soon. Sometimes we may have to wait 15 minutes to get the right move. But the key is, we don't want to just trade range breakouts throughout the day. It's good at the open because there's a ton of volatility, and most big traders realize that if they try to play that game, they can get blown up pretty easy, because there's going to be a lot of volume and a lot of volatility. So they don't typically play that game unless there's just not a whole lot of volume. And that's why volume is key. If you try to trade an opening range breakout and the volume is low, you'll probably get stopped out because it's easy for them to play with stocks on lower volume. So that's why volume is really key. All right, so as we said before, every stock is going to establish a opening range. I think, let me get in. Excuse me, Tesla's not going to bounce, but it's breaking a low. So it'd be worth giving it a run here. All right, so every stock creates an opening range with a specific time frame at the open. We talked about that. It could be all the way up to 60 minutes. The high and the low of the range is going to act as our support or resistance. That's why I draw the solid line at the opening range low or the opening range high. Okay, so in theory, and this is the way it's supposed to work, when the stock breaks above the opening range high, you're going to go long. That's the opening range breakout. You're not going to think twice. When it breaks it, you go. When it moves below the opening range low, that's the opening range breakdown. And as soon as it does that, you short. It's supposed to be that simple. The entry is supposed to be that simple. All of the work is done prior to the entry setting up. That's the planning part. And you'll see as we go through the strategy, that's what's going to take the time. That's why we start at 8:30, and that's why I don't come in at 9:15 and try to build a watch list. We do it at 8:30. We get stocks that has volume, that has the potential, and we're going to build a trade plan so that when the market opens, we're not trying to figure out now where we're going to put our stop. Where we're going to take profit. After you get in the trade is not the time to start deciding all of that. That's why following people in trades don't work. That's why alert services don't work. Telling you to get in at this price and then you have no idea what to do once you get in. You know what you're looking at. So it's important to actually have a plan in place before we actually get in and take the trade. Come on, Roku. You need to. No, Tesla needs to crack 230. So simple conditions that have to be met before execution. These are the things that have to be in place before you even execute a trade. Number one, we said you got to have a plan. That's a no-brainer. So whatever time frame you're working on, if you're working on a 15-minute, then you want to have the 15-minute, either 3 5-minute candles or 1 15-minute candle has to have printed and closed. All right, if you're going to do the opening range, the way I trade it, the stock has to have broken out of it by 10 o'clock. Now, 90% of the time, if a stock is breaking the opening range high or the low after 10, it's a trend continuation trade. That's what it is. It's not an opening range breakout or breakdown. It's a trend continuation trade. Because by 10 o'clock, it's jumped around and it's tried to put in a trend, and it's just going to continue in the trend that it put in. So the quicker the market breaks above or below the opening, the better the odds of the trade working out. Most breakouts that occur later in the day, like I said earlier when we talked about trading range breakouts throughout the day, you don't have enough momentum to sustain any big move unless you get breaking news. That's the only thing that's going to give it volatility to help sustain it after the morning rush, because you just won't see it. Now, typically after 3 o'clock, you may see some volatility come in around 3:30 when people are having to get their positions in place. You know, Suretrader isn't the only one you got to be at 2-to-1 overnight. You know, so people are that may be holding, you know, they're having to size down and get their accounts in place in order. So you may see some more volatility coming in later in the day. But our focus on this opening range trade, nice, is at the open. Man, Tesla's doing it. Crack 230. It's got to get through 229. Take out the low of that big flush candle. It's all over. Put a fork in it. It is done. All right, so I need to see a bias toward one particular direction. Now, again, let me qualify this. That doesn't mean I'm looking to trade it in that direction. I want to see a bias towards that one particular direction. And so what happens when we see markets swing back and forth and just kind of trade sideways, then you'll know, and I tell you, I'm dropping it off my watch. It's just trading sideways coming into the open. I'm not going to really look hard at it. Now, it may come up for a secondary trade, but I'm not focusing on it as much. And that's because there was no particular direction it was starting to move in. So the ideal market action prior to breaking out of an opening range is when the market either tests the highs or the lows of pre-market more than once, or at least once, and it breaks it. So, or breaks it to the high or to the low. It doesn't matter. Whatever it does. So what I don't want to see is a stock that's choppy, that keeps jumping around. Even if it may be trending up, I don't want to see huge indecision candles all the way up. You know, I don't, or all the way down. I'm not comfortable trading that. So, and again, the last condition that must be set is volume. There has to be substantial volume and gradual buildup or increase in volume leading to the breakout. Gotta see that. Or breakdown. The vast majority of the time, the market is going to peak. The volume is going to peak within the first 15 minutes and the last 15 minutes of the trading day. Remember, I say I'm moving that to 30 minutes. The peak volume is in the first 15 minutes, but I look at the first 30 minutes as having the most volume in the market, and then the last 30 minutes, you know, after 3:30, that's when we start to see volume. Actually, it starts coming in at 3, but 3:30 is when it really kicks in. So, you know, as a result, volume at the 30-minute mark, it typically falls off, and it makes it hard to gauge volume. So, you know, one of the rules for buying a breakout is volume. And if you're not having really good volume, you can get a little volume spike based on the previous sorry candles. That's just there to fool you. That's not a significant, you know, thing right there. So, you know, you want to make sure that we're trading these breakouts in the right spot at the right time during the day. So my solution to deal with volume drying up is simple. As long as the volume is dropping out gradually and it's still within the range that existed, during the first 15 minutes or so, it's good. I'm good with it. So I will trade it within that first 30 minutes. However, if we have two big candles at the open and then the volume just like goes to kaput, then we're done. Okay, we are out of it. There's no way to trade that, because whatever move it makes can be a fake out. Or with low volume, somebody with the size and the capital can come in and move that stock wherever they want to move it. Shake out whoever they want to shake out before letting it go to where it's going to go. So volume is key, guys. So here are my candidates. And we went through the scanning in, I think, the second class. We'll review it again real quick. But the candidates has got to hit my ORB pre-market scan. Now, I will move over to the earnings scanner and, pick up some stocks that may have a little bit higher float, but they're not going to be my number one picks. My number one picks are going to have a float between 50 to 500 million shares, a gap at least $1, a good ATR, and I have 50 cents here. That's usually the summertime, but I'm really looking for it over $1. Got to have a solid catalyst. No catalyst, no trade. All right. I've broken that rule a couple times on Roku because of how it trades. But as a rule, got to have a solid catalyst. Earnings are my favorite. My least favorite is going to be analyst upgrades, because a lot of times it's BS anyway. But I like earnings. I like the FDA approvals, stuff like that, government contracts, anything like that. Can you please go over again why we want the float less than 500 million? Because it doesn't take a whole lot of volume to move it. If you get into these 4 or 5 billion share float stocks, they typically don't move. Even when they get a catalyst, the moves are so small, you can't really make money off of it. So most of the stocks that I found that make the nice moves that I like are going to be stocks with between 50 million and 500 million share float. And that's based on the way I trade this strategy and my back testing over the last several years. And this hasn't changed in the last 4 years. This has been the same for the last 4 years. But I always reserve the right to bring in another stock that may have a larger float that has the potential to move. Like if it has a 1 billion share float and it's got an ATR of $6, hell yeah, that's something I can take care of, because it has the potential to make that big move. And we're looking for a solid daily chart. Got to have a solid daily chart. I don't want a daily chart that looks like chopped up mess, or you've got a bunch of tiny candles that has a range of 20 cents. That you can tell the ATR is going to be really low. So you're not going to have a good ATR when it comes to that. All right, so just to sum it up, the opening range is defined by the high and low of the chosen time frame. The 9 to 20 EMA, we went over moving averages last week. Hopefully you remember, you understand exactly why I use the EMA intraday and the 20 EMA on the daily, and why I use the SMA on the daily charts and then the 200 on the intraday. The entry should be made only out on the close outside of the trading range. You don't want to get inside the trading range. You want to get in outside that opening range, because you're going to use that level as your stop to tell you, hey, if you close back below that level, it's time to get out, because it's not holding yet. You may have to get out and get back in. You can always get back in. But if you sit there and let it run against you and blow you up, then you're not going to be in the right mindset to get back in this. So your initial stop should be using that technical level, which is an opening range, high or low. Now, as you get more comfortable, you may start using moving averages or the VWAP or whatever. But when you're learning this strategy, you have to follow the ABCs until you are comfortable reading price action and really being able to understand what's happening at a certain point. You have to be mechanical in what you do. And going forward, these next several months, I'm going to be trading this strategy as mechanical as I can, so you guys can see. We'll be trading smaller size and helping you understand where to put your stop, how to manage your risk, because you have to do that. You got to get that down pat, because you can make a ton of money trading this strategy, but you got to get the fundamentals down. You got to get your discipline and your patience and be able to trust it. Because if you don't trust it, you'll start trading your P&L and taking the trade off before you're supposed to, not sticking to your stop because you don't want to be wrong, and all of this good stuff creeps in. So we don't want to do that. So if no technical levels are present, which is impossible, then we'll use a candle closing below the high of the trading range in a long position, or above the low in a short position. And this is something that it may not make sense now, but when we see it on a chart and we start trading it, it's going to make sense to you. But the key is respect the support and resistance levels. Do not buy below it, or don't short above it. Don't short into support, and don't buy into resistance. You don't want to do that. All right, any questions so far? We're going to look at the trade from today. This was an opening range break that completely failed. And once I did my recap, once I did my reflection on it, I realized very quickly that I messed up. So if trading 5-minute breakouts, we have to wait until the close of the bar that made the break. No, you don't have to. Now, there are two different entry strategies for this setup. You can trade on the break. That means as soon as the next candle breaks to high or low, you can get in. That's the more aggressive entry. The more conservative entry is waiting for that next candle to close outside of the breakout. And I used to do that back when I first started. I traded it as conservatively as I could. But now the market just isn't, it's not receptive to that. So what ends up happening is you don't get as many trades off. You do get some trades, but you don't get as many off. All right, and I'll show you when we get onto this chart here. Okay, so LEN, this was the opening range breakout. Okay, you see we've got the big opening range candle. We had a gap up, and we sold off coming into the open, and then we had this huge volatile candle here. All right, so I'm expecting, okay, the first 5-minute candle, we got the volatility out and we're good. This candle opened here and we started to push up. We were a solid green candle. And, I got in for the break. I waited a couple ticks because I wanted to make sure that it was going to more likely stay above this. So I kind of hesitated for a couple of minutes. Well, a couple of seconds, but that was by design. I intentionally did that. So I got in, we started to make the move up, and then the bottom fell out. Still volatile. This candle opened, sold off a little bit, and then started to make the push, and I felt a little bit better about this. And I'm like, yeah, this is good. And here is the pre-market resistance. Here's a pre-market resistance level. You want to pay attention to these guys. Pre-market support and resistance plays a key pivotal role in opening range breakouts and breakdowns. They play more of a significant role than the daily levels. So if you don't pay attention to any level, pay attention to the pre-market level. So here's a pre-market support. Here's a pre-market high. This was my target. All right. I just, the mistake I made was expecting this to just trade through this. Like if this was a daily level, I'd have been okay with taking a trade here. But this is a pre-market level, and this is solid. You can see exactly what happened. It got rejected here. And what I should have done was taken it off. As soon as we broke this, we broke below the low. And this candle made a new low. This is where I should have stopped out. The strategy requires you to stop out there. That's the mechanical stop. But me and my infinite wisdom, because I know how to read price action, and I think I know best, I held on to this thinking that, hey, we may get a bounce. Well, during this time, it reaches my max loss. But instead of me selling my position, I actually bought it. So I hit the wrong button. Instead of killing the long, I hit kill short, and it added, and it bought me 200 more, and then I had to go ahead and close it out. But that was just an accident. But should have been out of this trade right here. Right there is where I should have been out. When this candle closed below the 5-minute opening range high, and then this candle made a new low relative to this candle, this confirmed that we're rejecting the 5-minute opening range high and that my trade plan is dead. Your stop is just that simple. On these trades, your stop, what's going to tell you that this trade is not going to work is when your candle comes back, closes below the 9, below the opening range high, and then the next candle opens, it can't push higher, and it breaks the low of this candle, that's your trigger to exit. Now you're gonna have a max loss too. You're gonna have a maximum amount of money that you're willing to lose on this trade, because what can happen, this thing can wash out, and you want to have your max loss to protect you so that you won't lose but X amount of dollars on the trade. But what you shouldn't do is, once your technical level is broken, sit there and wait and say, well, I was going to risk this on the trade anyway, so I'm just going to let it hit. That's not very smart. It's not very smart on my part, because I just gave away this is the last day, and I just gave away, $150 that I didn't have to give away. Well, not $150. I gave away probably $75 that I didn't have to give away. I was still going to take a loss on this trade, but it wouldn't have been as much. So, that's why it's really important. And we're going to focus on this. And we're going to talk through this. When we make our trade plan, we're going to talk about where the potential resistance, where the target is. Whenever you've got a opening range, a pre-market high far enough away for it to be a really good profit target, that's your target. That is your target. But when you have something like this, that's like 30 cents away, that's not going to cut it. And that was the first mistake I made. Second mistake, I did not take it off when I was supposed to. Even though it's not that big of a loss, if you look at it relative to a small account size, that's pretty significant. And we can't take those. Those we just can't take. Well, you don't know anything. But Ryan, I've seen this happen thousands of times. That's why it's a rule. I didn't make it up out of thin air. This happens over and over and over again. So that's why I said you got to pay attention to this. That's why I mark these every day. It's not, everything that I tell you is not going to be something I'm adding because I want to put more sauce on the taco. We're going to have as few rules, as few moving parts as we can, because that's going to make us the most consistent. And that's how we're going to make it to the next level. Got to be consistent. We got to respect those. But if you think about it, it doesn't matter what level you have. You're not going to know what the effect of that level is going to be until the stock gets there. You have no clue. Like right here, here's a 200. We can assume that it's going to bounce here. No, that we can assume, but we don't know that. But in this instance, it did. Here we're selling off. We could assume the same thing, that it's gonna bounce here. We have no idea whether it is or not, but it didn't. It sold off. So you have to respect these levels, and you have to assume that the stock is gonna react here. Yeah. If this trade came up tomorrow, no, I would not take this. Because, like I said, I made a mistake here. And you've seen me many times just this year where I didn't take the trade on the break of the opening range. I waited till it got over the pre-market high. And then I took the trade. That's how much I respect the pre-market levels. But that's another reason why we have to do this. Learning this in this class setting and going over this, it may not help you tomorrow because tomorrow is going to be different. It may look like the exact same setup, but the market's going to be different and it may react differently. But if we are consistent with our actions, with our execution, doesn't matter what the market does. We just do our thing day in and day out, day in and day out. We trade this strategy day in and day out. The more we trade it, the more experience we get with it, the more we're going to realize that, hey, all you got to do is execute the strategy. We can't control where it stops, where it starts. We can't control any of that. The only thing we can control is putting our trading plan together and then executing it. That's the focus. That's the secret. And there's no secret. No, you have people that's, I've got this secret strategy, or I know the secret is executing a viable strategy consistently in the market. Well, you're not really letting go of any control you never had it to start with. So you're not letting go of any control. You just have to accept the fact that you have no control. You have no control over where the market goes, what it does at any point. So all you do is you have a strategy that you have confidence in that says, okay, the stock is more than likely to go here. And out of 10 trades, and really I shouldn't even use 10 trades, because if you use 10 trades, you can still have a 40% win rate. But if you go over 25 trades, then you may have a 60% win rate. So it's just that you have to know that, hey, the only thing you can control is building your trade plan and executing it. And the market's going to do what it's going to do, how it's going to do it. And all you can do is sit back and make your moves based on what the market does. Because if you sit here and try to control it, you're done. You are done. All right, any questions? Now tomorrow we're kicking this thing off. We're going to be focusing on the mechanical aspects. We're going to be building a trading plan. And we're going to be looking at executing that plan every day. We're going to talk about the levels of support and resistance that we draw on a daily chart. Now, they're not going to make sense until we do it with the market open. I do it every day, and some people dismiss it. Some people don't show up until 9:15 because unfortunately that's all they can do. No, but we've got to find time to vet these stocks. You got to find time to draw the levels and build a trade plan around it. Because looking at this, there was no trade here. No trade. Nobody, and me taking it was me rolling the dice and not thinking it through. Oh, definitely that's one of the takeaways. The pre-market highs and lows, I mean, they're solid, man. That's why I mark them every day. That's why I mention them every day. It's very solid. You don't want to ignore it. You know, I don't care about the previous day's high or low. You never see me mark that. I could care less what it did yesterday. But I'm damn sure going to mark the pre-market high and low if it, comes into play. Not going to ignore that. Because see, here's the thing. What it did yesterday is not based on the catalyst that's making it move today. So whatever catalyst, and most of the time is earnings, it didn't move on in an earnings announcement the day before. Now, if it was earnings announcement after the market closed, that's all in that shaded area on Thinkorswim. So that's in play. Why the 8 a.m. and not the 7 a.m.? I'm not sure what you're asking. Pre-market starts at like 4 a.m. Or if you look at, hold on once, let me show you this. That's not the right chart yet. All right, look at this. Where does pre-market start? 1 a.m. Some stocks, let's look at Apple. The SPY trades, like I said, 24/5. Look at Apple. When does Apple pre-market start? 4 a.m., buddy. 4 a.m. No, okay, look at this. All right, it's 4:30. 4:45, 1,200 shares. And then here at 8 o'clock, 1,200 shares. No more people came in at 8 o'clock trading Apple than they were at 4 o'clock. Same amount. It just depends on when whatever market maker is holding those stocks. When they open up, that's when the market for that stock opens. Look at Apple, but then let's look at it's another one, SFIX. When did it start trading this morning? 5 o'clock. So whatever market maker was holding this, they kicked it off at 5 o'clock. But what do we see here, guys? This is pre-market high. Did it ever break the pre-market high today? Let me zoom in on it so you can see. Pre-market high. Did it break the pre-market high? Absolutely not. So better respect it, guys. Better respect it. All right, and here's pre-market support. Here's pre-market resistance here. Shit, it held. That even held. Look, here's pre-market. Here's a pre-market resistance level right here. We got wicks above it, but did it ever close above this level? No. I'm just picking these out of the damn air. You gotta respect it, especially with opening range. All right, guys. I'm gonna stop the recording here. We got our hour in. We're gonna stop the recording here. But if you have any questions, feel free to ask. I'm right here.